If you're 62 or older and you own a home, there are some important updates to federal tax reporting rules that are worth understanding in 2026. These changes involve reverse mortgages, home equity withdrawals, and certain property transactions, moves that many senior homeowners make every single year. Understanding how these transactions are reported to the IRS can help you stay prepared and avoid unexpected surprises at tax time. In this Senior USA guide, I'm going to break down what reporting requirements exist, who they affect, what the IRS tracks, and 3 practical steps you can take right now to protect your home, your income, and your retirement. Let's get into it. For decades, senior homeowners in the United States have enjoyed certain financial advantages that most working-age Americans don't have access to. You've paid into your home for years, sometimes your entire adult life. You've built up equity. You've watched that investment grow. And for many of you, that home is your single biggest financial asset, your nest egg and your retirement cushion. It represents not just a place to live, but decades of discipline, sacrifice, and smart financial decision-making. For many seniors, it's the one asset that has consistently appreciated over time, outlasting stock market swings, economic downturns, and unexpected life events. Historically, tapping into that asset through things like reverse mortgages, home equity lines of credit, or property sales has involved reporting obligations that many homeowners weren't fully aware of. That's an important distinction worth understanding. The rules have always existed, but the level of awareness among everyday homeowners, particularly seniors who may not have a dedicated financial advisor reviewing every transaction, has often lagged behind the actual requirements. That gap between what the rules say and what people know is exactly where tax problems tend to develop. Certain financial transactions tied to senior homeowners are required to be reported to the Internal Revenue Service. The reporting rules primarily apply to 3 categories of financial activity. First, reverse mortgage disbursements. Specifically, the lump sum payouts and monthly payment streams that seniors receive when they tap into their home equity through a home equity conversion mortgage, or HECM, which is the most common type of reverse mortgage insured by the federal government. Second, home equity loans and home equity lines of credit, known as HELOCs, where the borrower is over the age of 62 and the loan exceeds a certain threshold. Third, property sales, where the transaction generates what the IRS classifies as a reportable gain or income event. This doesn't mean every home sale or every reverse mortgage automatically creates a tax problem, but it does mean these transactions are reported in a way that matters, and that distinction is important. The IRS has more visibility into these transactions than many seniors realize, which is precisely why being informed and prepared makes such a significant difference. The IRS conducts regular data analysis on tax compliance across different age and income groups. What their research has found is that some senior homeowners who receive large sums from home equity through reverse mortgages, property sales, or equity loans may not be fully accounting for all the tax implications on their federal returns. In some cases, this is simply an honest mistake. People genuinely didn't know that certain proceeds could trigger taxable events. In other cases, information was simply incomplete or poorly organized at filing time. Either way, the result can be a discrepancy that draws attention. The financial institutions that handle your reverse mortgage, home equity loan, or property closing are legally required to file disclosures with the IRS when these transactions occur with a senior borrower. In plain terms, your lender reports the transaction to the federal government. The IRS receives the report when the transaction occurs. So if there's a discrepancy between what your lender reported and what appears on your tax return, even if that discrepancy is completely innocent and the result of a simple misunderstanding, it can trigger an automatic review flag. Being prepared in advance is always the better position. Let's say you've been receiving monthly payments from a reverse mortgage. Your lender files information with the IRS detailing the total amount you received in disbursements during the tax year. When you file your taxes, if that information doesn't appear on your return in a way the IRS finds satisfactory, their systems may flag the discrepancy. That flag could result in a letter asking for clarification or, in some cases, an audit. If an audit reveals an underpayment, it can mean penalties, back taxes, and interest charges. None of those outcomes are pleasant, and all of them are far more manageable when you've prepared your documentation ahead of time rather than scrambling to explain transactions after the fact. Here's something critical to understand though. Reverse mortgage proceeds themselves are generally not taxable income. In most cases, the money you receive from a reverse mortgage is not classified as taxable income because it's essentially a loan against your home equity. However, and this is a significant point, the IRS doesn't just look at disbursements in isolation. When they receive a report that a senior homeowner has been receiving substantial sums from their home, they also look at the broader financial picture. They look at whether Social Security benefits have been properly calculated, whether Medicare Part B or Part D premiums should be adjusted based on income, whether deductions related to your home's financial status were properly handled, and whether any interest deductions on your reverse mortgage or home equity loan were properly recorded. Any one of these areas can become a problem if your paperwork isn't in order. Home sales are an area where many seniors encounter unexpected tax situations. Under current tax law, if you sell your primary residence and you've lived there for at least 2 of the last 5 years, you can exclude up to $250,000 of profit from your taxable income. If you're married and filing jointly, that exclusion goes up to $500,000. That's a significant benefit, and most homeowners are aware of it in general terms. But here's what many people don't fully understand. The exclusion only applies to your primary residence, and there are specific rules about how the gain is calculated. If you've made improvements to your home over the years, those improvements can increase what's called your cost basis, which reduces your taxable gain. But you have to have documentation of those improvements. You have to be able to prove what you spent. When your real estate closing agent files their report with the IRS will know the full sale price. If your taxable gain appears to exceed the exclusion and you don't have proper documentation of your cost basis and eligible expenses, you could end up with a larger tax bill than expected. Think about it practically. If you bought your home in 1985 for $85,000 and you're selling it today for $680,000, you've got a gain of nearly $600,000. After your $250,000 exclusion, or $500,000 if you're married, you could be looking at anywhere from $100,000 to $350,000 in taxable gain, depending on your filing status and documented cost basis. If you've renovated your kitchen, added a deck, replaced the roof, updated the bathrooms, and put in new flooring over the past 40 years, all of those improvements can add to your cost basis and reduce your taxable gain significantly. But you have to have records. Receipts, contractor invoices, bank statements showing the payments. Without documentation, the IRS will use the numbers from the closing report, and the tax bill could be much higher than it needs to be. It's also worth understanding what happens when a senior sells a home that wasn't their primary residence, perhaps a vacation property, a second home, or a rental property they've held for years. In those cases, the $250,000 or $500,000 exclusion does not apply. The full capital gain becomes taxable, and depending on how long you've owned the property and your overall income level, the tax rate on that gain could be significant. If you're in this situation, working with a tax professional well before you close the sale gives you the opportunity to explore strategies like installment sales or 1031 exchanges that may reduce your tax burden in a legal and structured way. Social Security is an area that surprises many seniors. Most people know that if you work while collecting Social Security benefits before your full retirement age, some benefits may be temporarily withheld. But what many people don't fully realize is that income from other sources, including investment income, rental income, and in some cases income related to your home, can affect how much of your Social Security benefit is subject to federal income tax. Here's the rule as it currently stands. If your combined income, which includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits, exceeds certain thresholds, up to 85% of your Social Security benefit becomes taxable. For an individual, the threshold where up to 50% of benefits becomes taxable starts at $25,000 in combined income. For up to 85% of benefits to be taxable, the threshold is $34,000. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. If the IRS receives a report that you received a large lump sum or a series of substantial payments related to your home equity, and that information increases your perceived combined income, even if the money itself isn't directly taxable, it can potentially affect how your Social Security benefits are being taxed. This is a nuance that even experienced tax preparers sometimes overlook when working with senior clients. The interaction between home equity transactions and Social Security taxation isn't always obvious, but it can have a very real impact on your monthly take-home income. If you're relying on Social Security as a primary source of retirement income, any reduction in your effective benefit, even a partial one, can affect your ability to cover basic living expenses. Understanding this connection in advance allows you to plan accordingly. Medicare premiums are another area where seniors can be caught off guard. Most people know Medicare coverage has monthly premiums, and most people pay the standard rate. What many people don't know is that if your income exceeds certain thresholds, your Medicare Part B and Part D premiums can increase substantially under a provision called the Income-Related Monthly Adjustment Amount, or IRMAA. The income threshold calculations for IRMAA are based on your modified adjusted gross income from 2 years prior. So if you had a significant income year, maybe from a home sale, a large HELOC withdrawal, or another transaction, your Medicare premiums in subsequent years could be higher than you expected. For someone on a tight budget, that can be a genuine hardship and is worth planning for in advance. What makes IRMA particularly frustrating for many seniors is that it can feel like a penalty for doing something completely reasonable, like selling a home you've lived in for 30 years or accessing equity you've spent a lifetime building. The increase in premiums isn't a punishment, it's simply the result of a formula that treats certain income events as indicators of higher financial capacity. But if you weren't expecting it, the sudden jump in monthly premiums can feel shocking. The good news is that if your income was temporarily elevated due to a one-time event, like a home sale, you can request a review and provide documentation to Medicare showing that your income has since returned to a lower level. That process exists specifically for situations like this, and a tax professional or a Medicare counselor can walk you through it. Now let's talk about the practical steps you can take, because everything I've described up to this point is the problem side of the equation. The solution side is actually more manageable than you might think, but it works best when you act in advance. Step 1. Meet with a tax professional who specializes in seniors. The single most important thing you can do is to schedule a meeting with a tax professional who has specific experience working with seniors and retirement income, not just a general tax preparer. A tax professional who understands the intersection of home equity, Social Security, Medicare, and federal reporting requirements. This distinction matters. A lot of general tax preparers are excellent at what they do for the average working person, but the financial picture for a senior homeowner is genuinely more complex. When you sit down with that professional, bring several things with you: your home purchase documentation, records of any major improvements you've made over the years, your most recent reverse mortgage or HELOC statements if you have them, your last 2 years of tax returns, and any statements from Social Security or Medicare you've received recently. That package of information gives your tax advisor the full picture they need to identify any potential vulnerabilities in your situation before they become a problem. One thing worth noting here is that not all tax professionals charge the same way or offer the same level of service. Some charge by the hour, others charge a flat fee per return, and some offer ongoing advisory relationships that go well beyond the annual filing. For a senior homeowner with a complex financial picture, especially one who is considering a home sale, a reverse mortgage, or a major HELOC withdrawal, an ongoing advisory relationship may be worth the investment. Having someone in your corner who knows your full financial picture throughout the year, not just at tax time, can make an enormous difference in how well prepared you are for whatever comes next. Step 2. Get your home improvement documentation in order. If you've owned your home for 10, 20, 30, or 40 years, you've almost certainly made improvements that qualify as cost-basis additions. The problem is that the older those receipts and invoices are, the harder they are to find. Some may be in folders you haven't opened in years, in storage, or in old email accounts and online banking records. Start gathering those documents now. If you've lost the original paperwork for older improvements, your contractor might still have records. Your local building permit office may have records of permitted renovations. Your homeowner's insurance records may show when significant systems like your roof or HVAC were replaced. Any documentation is better than none, and even partial documentation can meaningfully reduce your taxable gain when you eventually sell. As you gather this documentation, consider creating a dedicated folder, either physical or digital, where you keep all home-related financial records going forward. Scan older receipts if you have them. Save contractor invoices as PDFs and keep a running log of any improvements you make each year with approximate costs and dates. This simple organizational habit can save you thousands of dollars and countless hours of stress when it comes time to sell your home or respond to any IRS inquiries. Step 3. Review your reverse mortgage or HELOC situation. The rules around what is and isn't taxable in the context of a reverse mortgage are actually fairly favorable to seniors, but they're also fairly technical. If you currently have a reverse mortgage, ask your servicer for a complete transaction history showing all disbursements and any fees or interest charges. Make sure that information is ready to hand to your tax advisor. If you're considering a reverse mortgage, now is an excellent time to consult with a tax advisor before you sign anything so that you understand the full financial picture and can structure the arrangement in a way that minimizes unexpected tax consequences down the road. IRS reporting requirements for senior homeowners are real, they are significant, and they affect the way the federal government sees your home equity transactions. Reverse mortgages, home equity loans, and certain property sales generate reports to the IRS. But here's the good news. If you understand the rules, get your documentation in order, and work with a qualified tax professional, you can navigate this confidently, without fear, without surprises, and without overpaying a single dollar. The goal isn't to pay more than you owe. The goal is to understand exactly what you owe, document it properly, and pay it accurately. Nothing more and nothing less. The proactive approach is always better, always less stressful, and almost always less expensive than the reactive one. Subscribe to this channel for more valuable content and updates for seniors navigating retirement finances.